So Quant Fund by definition is a systematic offering. It's a rule-based algorithmic approach to portfolio construction, stock selection and portfolio construction. And what you have here is inputs that are all data-driven. You can have several different approaches, just like no two growth managers are same, no two value managers are same, no two quant products are the same. Each house can design quant fund that suits their taste, right? Yeah. So you could have a quant fund that is biased towards quality. You can have a quant fund that's balanced, as in case with my Axis Quant Fund, or you could have a quant fund that's momentum driven, right? Which is the case with Axis Momentum Fund. Yeah. So quant as a top level basically means offerings where there is no fund manager sitting down and saying, I like stock A or I like sector A, let's put that to work. So you avoid some of those emotional biases in there, and it's more driven by a rule-based algorithmic approach.
Yeah. Folks, welcome to PaisaVaisa. I'm your host Anupam Gupta, and on today's episode, I'm thrilled to welcome Karthik Kumar, Fund Manager Equity at Axis Mutual Fund. We are going to talk about momentum investing and much more. Karthik, welcome to PaisaVaisa. It's always great to have Axis Mutual Fund with us. Last time we had Debunking from the debt side. You're the first person from Axis on the equity side. Welcome to PaisaVaisa. Thank you so much for doing this for our audience.
Thanks for having me. My pleasure.
Yeah, and we are talking about. So tell us about the fund. When is it open? Is it already open or will it?
So the NFO period for the fund closed. It just closed last Friday. Yeah. And so now we get into the operational part of it, and then the fund gets deployed over the next week and a half, 2 weeks.
Whatever those old days where NFOs used to mean a lot and 10 rupees NAVs used to optically look really great. Yeah. I'm glad they're over. So NFO, no NFO, now the fund will start at some point of time.
Yeah.
Momentum investing, kind of a buzzword, right? Last, I would say, post-lockdown, it's become more popular or more consumer facing. Mm-hmm. It's been around for a long time.
Correct.
So can you just start with what exactly it is?
Okay. So firstly, as you rightly pointed out, momentum investing has been around for a long time. Basically, it works across asset classes, be it FX, commodities. It works across asset classes and globally within equities as well. The catch here is, if I were to give you a parallel, you think about a batsman who's done well over the last 8-10 innings, and the batsman comes out to bat. You're fairly confident that the batsman will make a change to the game or make a difference to the game, right? Yeah. And the same way, other way around, if the batsman has not done anything for the last 8-10 innings, then we are very apprehensive if the batsman comes on to bat. Yeah. So what we say in our parlance is the batsman's form is not great, right? So what you call form in cricket translates into momentum in investing. And I refer investing very broadly because it works across asset classes. So what you do in momentum is the idea is fairly simple. The idea is basically saying, what are the stocks that have done well over a recent time horizon? Yeah. And the time horizon of how long a time horizon are you going to use depends on what platform you are on. You're a hedge fund or you're a mutual fund. What is the size of your fund and so on and so forth. So there's a whole range of windows that you can look at. But the simple logic is stocks that have done well in the recent time period tend to do well going forward, and stocks that have underperformed will continue to underperform. That's largely the logic. There are exceptions to that rule, but but that's largely the rule. Yeah. Because you do have trend reversing signals as well, but we'll leave that out for now.
Yeah. So there are a lot of myths surrounding it also. People who believe in momentum are like very pro, and they have a certain point of view on that is the only thing that actually delivers, and that's it. But the way it's understood from retail investor perspective can be a little bit different also. So what are some of the myths surrounding this momentum investing?
So couple of them, especially when you talk about myths with regard to momentum investing for retail investors. Yeah. Typically retail investors, at least the interactions I've had, people tend to think momentum is catching every up move and avoiding every down move. Yeah. It doesn't, unfortunately, as interesting as it sounds, it's very difficult to kind of catch it, right? The other thing is it's more than just herd mentality. That momentum works for a reason, and we can delve into why actually momentum works. But there is science behind it, there is behavioral finance behind it in terms of why momentum works. So it's not just pure herd mentality. Third, people very casually say markets are falling, momentum is collapsing. Okay. The two don't have to be intertwined. The two don't have to be the same thing, don't have to mean the same thing. They could be on totally different the outcomes can be very different, even in a falling market. So those are the 2 to 3 main, I would say, misconceptions.
So I heard you saying about we'll get into how it works, or rather why it works. So let's just jump right in. I mean, I saw from your presentation there's a slide that says that it's actually delivered better risk-adjusted returns, which is kind of like the holy grail that you would want in your investing, whether you're institutional or whether you're retail. So why does momentum strategy work? And how does it deliver these better risk-adjusted returns?
There are a lot of research papers, especially because momentum effect goes long way back, and the data in US typically tends to be pretty long.
Very long.
So there is a lot of research there in terms of why actually momentum works. And one of the reasons from a behavioral finance standpoint is what we call underreaction or overreaction. So in underreaction, what we mean is typically the market, for some reason, is taking time to incorporate the new information. And which is why, as it incorporates that new information over stages, your stock continues to keep rallying over that time period. Now, as to why market takes time to digest that information can be down to things like anchoring bias, where you are, or where the market participants seem to disregard recent data in favor of what they already have seen over the recent past. That could be one of the reasons. A simple example will be, let's say there is a stock or a sector which is done poorly both from a fundamental perspective and from a stock return perspective over the last couple of years. And if the management comes out and says, I think there is light at the end of the tunnel, and I think going forward my numbers will start looking good, initial reaction from market participants will be, I've heard this story for the last 2 years. I'm not going to believe you.
Disbelief, yeah.
Exactly. Yeah. So now fast forward 1 quarter, let's say the management delivers on what they're saying. Then the earliest or then the smart investors who understand the sector probably will start taking in positions. The stock shows a slight improvement, performance, but majority of the investors are still sitting out, saying this is an exception rather than the norm, because we've seen the prior 2 years. Yeah. And now if the same thing happens for a couple more quarters, then everybody's convinced. Yeah. They say the sector's turned a corner, the stock's turned a corner, and then everybody jumps in, which is when you get that sharp rise. Yeah. Case in point is PSU sector, which was a value space for quite a long time.
Very long time. Yeah.
Very long time.
Everybody was worst is over, or whatever that cliche was. Yeah?
But it didn't kick in till, let's say, mid-2022. Don't hold me to the exact month.
Yeah, of course.
But it didn't kick in till 2022. And then once that sector started rallying with improvement in earnings, obviously, prospects, then people started taking comfort in the fact that earnings improving, stocks doing well, and now it's a value story as well. Yeah. It's cheap as well. Yeah. And then momentum kind of kicked in. Yeah. That's a classic case of why typically momentum works.
Yeah. I'm pretty sure it works on the other side also as well.
Absolutely.
So one of the most interesting slides in your presentation that I saw is that momentum adapts to styles or factors, as we call it, like quality and value. People who believe in quality will have a certain way of investing. People who believe in value have a certain way of investing. And both those schools have been around for like a very long time. Momentum adapts to both. I really want to know how that works.
That slide in the deck, while it's quite interesting, I've just limited that discussion to quality and value so that it is a lot more easier to understand. Simplicity. Yeah. But the catch here is momentum, in my eyes, is like a chameleon. And if you think about market as a background color, whenever the market changes color, your chameleon is momentum. It will change color to reflect what is working in the markets. Okay. So if there's a trend and the trend has been established and it's been captured by your momentum signal, then the momentum portfolio will start reflecting what is actually in favor or in vogue in market, right? So that could be style, that could be cap, that could be sectors, or that could be themes. Under specific themes under sectors. So you can traverse the entire spectrum. And so in my eyes, momentum essentially is your timer. It's a timer with a lag because you need to establish that trend, but it's a timer nevertheless. And it's a good timer.
I like the fact that you said two things. One, you said cap also, because cap is very important. Yeah. Everybody. I mean, cap stands for market capitalization, folks. That's what we mean when we say cap. The small and mid cap rally, for example. Yeah. You look back 20 years, there's been ups, there's been downs, and there's been a certain correlation between large caps and suddenly there's not, And then what you said about the lag part. The lag part is interesting. I think in the conversation that I've had with a lot of people, they somehow think that momentum is actually forward-looking. It can identify trends before. Okay, I don't know whether that's true or false. I'm going to ask you to just help people understand this lag factor. I mean, this lag effect, so to say.
To the best of my knowledge, you cannot predict a momentum effect. You can predict the possibilities by looking at, let's say, if the earnings of a certain sector is improving. You can look at it from fundamental aspect and start taking calls which the market may eventually latch onto. But to say that this is when momentum kicks in is very difficult, if not close to impossible. What I mean by lag is essentially to figure out whether a stock has a good momentum behind it. Is essentially you have to go and look at if there's a trend, and is the trend reasonably stable enough and for me to kind of invest in it. Because the bet that we are making is the probability of the trend continuing to go in the same direction is much higher than the trend reversing. That is essentially the bet we are making. So the more established the trend is, the more stronger that momentum in that stock is. Which means to measure that trend, I have to initially stay on the sidelines while the stock or the sector or the cap space kind of rallies a bit.
Sure.
And that is what I call lag, because first you need to measure it, which means you are not in the initial part of the rally, which is why momentum is all about buying higher to sell even higher. You will never buy at the lows, because at the lows, the momentum is poor. At the peaks, the momentum is always strong. So in both cases, you are not talking about getting in at the lows and exiting at the peaks. I would argue very few strategies can actually do that, but momentum definitely can't do that. It is always, it comes off the peak a bit, the momentum kind of slows down, and then you kind of exit it. So it works both ways.
Wouldn't we all love that, folks, catching a stock at its all-time low and selling it at its all-time high? But honestly, if everybody could do that, then I don't think you'd be sitting there watching this episode. But the best part in your slide, Karthik, is that there's this slide which says that when markets are falling, it's not necessary that momentum has to significantly underperform, right? People would think that in a rising market, if momentum gives me better than what the market is doing, then the reverse will also hold true. Okay, but that's might or might not be true, but not necessarily. So why and how does that work?
So if I were to carry on from our previous question as to how we measure momentum, we look at the trends and see if the trend is established, right? So for momentum to work, that trend has to continue. Sure. That is the basic underlying thesis, right? So if the markets are gradually correcting or gradually rising and the trends stay valid, then you could have a scenario where even in market correction, you could have momentum as a strategy doing much better than the broader markets. Case in point, 2011, when markets were down around 26%, momentum was down 16%. There was an outperformance of 10%, because that was the year when you had current account deficits and things like that. So the situation was evolving. It wasn't radically, like it didn't change radically overnight. Same thing with 2020, when the markets were falling during COVID. Feb and March, actually momentum did better, because by the time COVID hit our country, we already knew what it meant globally and the repercussions, and the market sector movements and the stock movements are already started reflecting that. So the trend continued, which is why momentum did well in 2020. And you could refer to the Nifty momentum indexes to kind of confirm that data point. So the question is, when will momentum underperform? Momentum will underperform when there is a sharp change in underlying drivers of the market, and the trends hence are no longer valid. So whatever trend I measured over the last, let's say, 1 year is no longer valid going forward, in which case my portfolio is no longer has the winners that will drive the market tomorrow, in which case momentum will take a bit more time to identify the new winners. And so during that period, you could see underperformance, and it can come both in an up market and or a down market. Sure. And I want to emphasize up market as well, because people don't think it's intuitive. For instance, you look at 2008 and 2009, 2008 markets fell by 57%. 2009 markets rallied by 90%. Momentum actually underperformed 2008 by only 2-3%. Okay. But on the way up, when the markets rallied by 90%, it underperformed by significant margin. In fact, momentum had one of its worst years in 2009 when the markets were rallying.
Wow.
Because now you have a scenario where essentially 2008, it was all about, let's say, being much more risk off.
Yeah.
And then suddenly the sentiment changes in 2009 because of central bank interventions and so on and so forth. And then animal spirits kick in. But the trends over the last 1 year don't show what worked in 2009.
So before we go into break, Karthik, as someone who's done Quant for quite some time, and now, of course, you're going to do momentum, both are kind of linked in a way also. Yeah. You think that anything has changed post-pandemic, or when you do your backtesting models, what was true in 2013 to 2019, and what's been happening in the 4 years, it's more or less consistent? Because just optically, top of the mind, when I see from 2020 onwards till now, the 4 years that have happened, it just seems to me that in Indian markets, of course, not abroad, every time the market falls, the market goes up without fail.
Yeah.
So people have just generally assumed, that this is a long-term bull market and this, that. Every time it's down. Like, for example, I remember last year when the Nifty had fallen, I think 7-8% or something, and then you had a 40% move.
Yeah.
Okay, and this October, it's fallen 11%. I don't know what's going to happen. As we sit here and talk, it could go anywhere. You think anything has changed that comes out in your backtesting model, or more or less it's still more or less the same?
It's more or less the same, because if these quant models are not in the business of predicting market direction.
Okay.
What they are trying to get at is outperformance across cycles, so be it an up market or down market. Predicting market direction is the holy grail. These are not about predicting the directionality of the market. It's more about saying, given the markets, where do you think you'll get better outperformance, and by avoiding which set of stocks can you avoid the drawdown or the downside and so on and so forth.
You don't think someone can sit at home and make an AI or ML model that actually predicts the direction and hits the holy grail? You think that's even possible?
I mean, to say it's impossible would be unfair, but at least as of today, I don't think there are many people out there who can claim to do that. Right.
Okay, folks, we're going to take a small break out here, and on the other side of this break, we're going to get a little bit more specific about identifying sectors, portfolio construction approach, and much more. Don't go anywhere. We'll be right back.
Hello! It's been another great week on IVM Podcast Network. On Cyrus Says, Cyrus chats with Miang Chang about his journey from Indian Idol to Badmash Company, some untold stories, and how comics and dentistry shaped his life. On A Century of Stories, Kunal unravels India's 4G revolution, a game changer that bridged the digital divide and brought affordable high-speed internet to the millions of people of India. On Mind Over Money, Sumaira explains what systematic withdrawal plan is, how it works, and its benefits. Folks, if you like our shows, spread the word. Tell your friends and don't forget to rate and review them wherever you are listening to them. Follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram, and LinkedIn. You'll also find all our shows on YouTube by their show names. So do look out for them and have fun watching. And finally, we would like to thank our sponsors of this week: IDFC First Bank, Axis Mutual Fund, SBI Mutual Fund, ICICI Prudential Mutual Fund, and IndusInd Bank.
And welcome back. Karthik, now let's get down. We spoke a lot about theory in the first half of this episode. I want to talk about the actual process, right? So how do you identify momentum trends? And are these theme-based or sector-based? I saw in your presentation you were mentioning something like, the sectors possibly to look forward to could be tech, green energy, manufacturing. So how does this work?
So to measure the momentum of any stock, what you do look at is you look at price returns over a certain time horizon. Typically, you look at price returns from 1 month to, let's say, 12 months with different windows in between, right? And you look at how good those periods are in terms of just the price returns over that period, and how consistent are those returns. So the more positive those returns are, and the more consistent those returns are, that means the stock has better momentum. It's a well-established trend. And the same thing on the downside. The more negative the returns and more consistently negative across time horizon, the poorer the stock could be going forward. So that's how you rank stocks based on momentum. And what happens is, typically when themes start working, or it is more bottom-up. So when you see, let's say, all power stocks doing well, then that it automatically becomes a power theme. You never go hunting for a theme. It is more bottom up. So if you see a lot of PSUs doing well, it can become a value theme. and so on and so forth. So you never go hunting for themes. Themes are just coincidence or outcomes of what you see at a stock level. And so you try and it's more bottom up rather than top down.
Do you add filters beyond that? Like you've got price action. Price action, like you said, could be 1 month, 3 months, 1 year, 10 years, whatever. And you will need for a set of conditions to be satisfied. Like 1 month needs to be positive, 3 months need to be positive, whatever it is. Okay. Are there any more filters that you add?
So typically when we design our universe, what we do is we do a couple of checks. First, the benchmark for the strategy is Nifty 500. So we start with 500 stocks. And then we'll do basic checks like we want to ensure that the liquidity across the spectrum is good enough. And when I say good enough, even during good days and bad days, and you don't want to see liquidity kind of dry away.
Right.
So we will filter stocks based on liquidity and how stretched liquidity can get. And obviously, other thing is if stocks have recently IPO'd, then you don't have the necessary price history to calculate momentum, in which case those stocks would be out of your universe till you get the necessary price history. So those two are the main kind of filtering criteria to decide our universe. Once the universe is decided, then we calculate the momentum score for each of those stocks. And the logic is fairly simple. Higher the momentum score, higher will be the weight of the stock in the universe, in the portfolio, and lower the score, the stock would probably have a low weight or would not figure in the portfolio at all. But to decide the weight, then we use a few other risk criteria to kind of figure out what the weight of that stock in that portfolio will be.
Yeah, very interesting. So, whenever anyone talks about momentum, I remember the adage, the saying that we have at least in the Bombay Stock Exchange, very Gujarati, Bhav Bhagwan Che.
Absolutely.
That's it.
Yeah.
So I don't look at annual reports. I don't look at profit and loss. I don't look at valuations. I don't look at all of that. The price is all that I see. And, maybe I'll add some few filters here and there, like you said, price history, IPO, etc. But profits, earnings and all that. Is this how it is, or is that also a layer that can be added?
That's a layer that can be added, but that changes fundamentally the nature of the product and the nature of the portfolio that you get and the risk profile of that product. So I manage another fund which is called the Axis Quant fund, which is kind of a blend of styles. Whereas this is completely momentum driven. What you alluded to is more a blend of styles, whereas this is momentum in its very raw form, right? So here we are saying the stock could be doing well for whatever reason, but as you hit the nail on the head, price is the king. So I'm going to go with what the market says. Market is always right, or to put it the other way. And so we'll take it from there.
Yeah. While I have you here, and since you mentioned Quant, tell us about Quant. What is Quant about? Like, what are Quant funds about? What is their process like? How is it different from momentum?
So quant funds, momentum is a type of quant fund. So quant fund by definition is a systematic offering. It's a rule-based algorithmic approach to portfolio construction, stock selection and portfolio construction. And what you have here is inputs that are all data-driven. You can have several different approaches, just like no two growth managers are same, no two value managers are same, no two quant products are the same. So each house can design quant fund that suits their taste, right? So you could have a quant fund that is biased towards quality. You can have a quant fund that's balanced, as in case with my Axis Quant Fund, or you could have a quant fund that's momentum driven, right? Which is the case with Axis Momentum Fund. So quant at a top level basically means offerings where there is no fund manager sitting down and saying, I like stock A or I like sector A, let's put that to work. So you avoid some of those emotional biases in there, and it's more driven by a rule-based algorithmic approach.
Very interesting. You mentioned fund manager. You mentioned particular approaches. It just feels like we are taking the personal element out. Like classic stock investing would always be bottom up, finding that value thing, going into price earnings, applying a lot of your human thinking to it. Whereas this seems to actually take those core things out, and apply a more unemotional, unbiased way of looking at things. You think that's, it just seems like an era is ending, or will that also continue? Will this also continue?
So a slight modification to what you said previously, I would actually put it as saying you take some of the great things that fundamental managers do, which is look at earnings, look at quality, look at how's the valuation, but you do it in a much more systematic way. What you're taking out is the part of doing channel checks, going and meeting companies and so on and so forth. So fundamental manager, that's why the way the two approaches differ is, fundamental approaches prefer to take extremely concentrated positions because they know the in and outs of a company. Whereas with quant, because you're betting on probabilities, right? A stock that is cheap, has better quality, has better growth, should do well. So now you don't want stock-specific risk. So the sizing, if you compare a quant a portfolio versus a fundamental portfolio, would always be on the lower side because I don't want to take stock-specific. I don't want to take too much stock-specific. That's the difference. But otherwise, I kind of agree with most of the things that you mentioned.
I used to be a sell-side analyst. It looks like my ex-job, might have a expiry date soon. If this, I don't think you would really need to speak to analysts for this, right? Because they are the guys who do this channel check, talking with management, arranging roadshows, etc. Whereas your approach seems to be more about just price and other factors.
Correct. But in a lot of cases, we are working on the data that the sell side puts out in terms of data, in terms of earnings expectations and so on and so forth. And also to put things in perspective, in US, Quant has been around for a long time, right? It's never about extremes. I think they both have a reason to exist.
Sure.
And they both will continue to exist because each of them have their own strengths and they have their own cycles. So actually having both these funds as part of your portfolio really helps in diversification because the kind of ideas that you capture with one, you probably don't capture with the other. The overlap is lesser. So it's like saying instead of having only one sector in your portfolio of funds, you're going to have a multi-sector approach.
Sure.
So I think the parallels are there between fundamentals and quant. So I wouldn't go the extreme, be it with fundamentals or quant, or for that matter, even active versus passive, which is again
a separate, much bigger debate that's been happening. Global events. Okay, now, there was one thought process that used to say that India is really not affected that much with what happens in the world because we're a domestic market, slightly smaller market. Of course, all that has changed completely now. We're as much impacted as pretty much a lot of other people. So how do these impact momentum, or influence momentum investing opportunities?
Global events, if they are very high impact events and are very different or completely out of the blue, what we call as black swans, in which case you don't know what the winners are going to be tomorrow and the day after tomorrow.
Sure.
So then I would argue in cases like that, you have a possibility where momentum could underperform in the interim. But if those global events are a continuation of what we've seen, either they are, let's say, they are picking up pace in the same direction that it was moving in, then momentum will adapt perfectly. That's not a problem. So it depends on what is the kind of change, what is the rate of change, and so that will decide whether it will impact momentum positively or negatively. Okay. But having said that, I would argue it is very difficult to predict black swan events. So if you think about it over a cycle, taking positives and negatives together, as you mentioned previously, momentum more than compensates you with good returns for the incrementally higher risk that comes as part of that product.
Yeah. So just winding down the episode now, what are the risks around momentum investing? So far, I've gotten this impression that it seems to be able to deliver pretty good returns, but there have to be risks. What are these risks?
So the first risk, as I put it, is a slightly higher risk strategy, higher risk, higher beta strategy. So people have to keep that into account when they are allocating capital to that strategy. Second thing, momentum can have sharp drawdowns. That's again something that we need to keep in mind, because if a certain trend has changed and it's changed very quickly, then you can get sharp drawdowns like what I pointed out in 2009. Case in point is 2009. So you could have both of those scenarios, and those I think are actually the main risks involved with the strategy.
Yeah. I wanted to just spend a little bit more time on the lag effect, because what happens is that retail investors in India, if they're new to momentum, let's say they've subscribed to momentum fund, they're holding it, as is very common these days, everybody checks performance. 1 month over, how did my mutual fund portfolio do? 2 months over, market went up, how does my portfolio do? Market goes down, how does my portfolio do? The lag might skew the results. Can you just talk about that? I mean, there's a good chance that when I'm doing this comparison, whether not getting into the merits of doing it, okay, because there's no point, but anyway. When I see that performance at the end of every month, or at the end of 3 months, or at a party where I'm with my friend who tells me that I invested in the mutual fund, which is great, and I look at it and say, hey, momentum was supposed to perform. But this lag is important. This lag might, seem off for a few months before you are actually able to get that trend. So that plays an effect in returns, right?
That
At least short term.
That only plays an impact when you are at the turning points. Let's say the market's in a turning point. There's a V shape, either V or inverted V. It plays a role because then you need to give it some time to identify the new trend. In most cases, what's happened, let's say I put together a momentum portfolio as of today. I'm going to invest in stocks and styles and market caps where there is already an established momentum. So there is no lag there. The lag aspect comes into play when there is a V-shaped change in the market. Till then, that's not an issue. But having said that, again, momentum, like every other strategy, requires discipline from the investor's side as well. So I think it will be ideal for somebody who's looking at a time horizon of 3 to 5 years. The thing I'd like to say is, you stay invested in momentum. Momentum will do the churning for you, or momentum will do the switching for you. As and when themes and styles change and new themes emerge, new stocks emerge, momentum will do that job for you. So you stay invested in momentum is what I say.
Who is this for? Actually, forget who is this for. I want to ask you about diversification because you mentioned that some time back, right? How would you think they should be positioned in an investor's portfolio? Retail investor again. What should they look at this as? And you mentioned diversification. So where does it fit in? How should I approach this?
Okay. So momentum is a thematic product, and it's a thematic product because it focuses on a certain style called momentum. But if you look at the portfolio itself, the portfolio is completely diversified. So it's diversified across sectors, it's diversified across cap space, and the number of names are fairly significant as well. So there is no stock level significant concentration. So it's a diversified product. So from that perspective, I think firstly, anybody can have exposure to the product as long as the time horizon is right. The other part is because this is a niche area and not many people have exposure to it. As I mentioned before, if you add this fund to your portfolio of funds, you are adding something new. You're not doubling down on the same set of ideas, the same set of themes. You're actually adding something that you don't capture already. So it gives you that diversification. So I think it can have a place in anybody's portfolio. Now, as to how much to have, again, this is not a house view. This is more my personal view. If it's for a conservative investor, I would say 7 to 10%.
Sure.
If it's an aggressive investor, then you can go much higher than that.
Who is this not for?
It's not for somebody who has a very short time horizon because you don't know if in short term, every style return is not predictable. Where be it momentum, low vol, high vol, whatever you call it, or even sectors, it is very difficult to predict. So if it's a very short time horizon, then that's not the product for you. And maybe if I were to take that definition further, if somebody is in their late stage of their career, working career or something like that, then maybe you may want to position yourself not too aggressively in this, very conservatively in this. Maybe that's something else to look at.
And just to clarify, this is an equity fund.
This is a completely equity fund.
65% max is the cap, or is that how it works, or it's something else now?
No, this is so equity fund. This will be, again, depending on how the SID is structured and so on and so forth, but at least 80% has got to be equity.
80%
has got to be equity. But in our case, it will be pretty much deployed because as I don't want to do market timing. So in our case, it will be completely deployed in momentum as a concept.
And hence capital gains accordingly apply. I think that's what I need to clarify out here. I just want to do a very quick recap on the portfolio construction approach in terms of, like you said, you start with Nifty 500, put in a price action layer, liquidity, just, so that our audience knows what this is about.
Okay. So first, as I said, we'll start with Nifty 500 as universe. Then what we'll do is we'll kind of cull out stocks where the liquidity is very stretched at the margins. Third, we will ignore some of these stocks that have recently IPO'd because they don't have the necessary price history. Then what we'll do is we'll calculate momentum score of all these stocks. But before allocating weight, we will look at two things. One is the liquidity of the stock and the other is the risk of the stock. So let's say we've got two stocks with exactly the same momentum score, but one is a lot more liquid than the other. Sure. Then we would allocate more weight to the liquid stock rather than the relatively illiquid stock because you want to get in, get out with less market impact costs and so on and so forth. And the same thing goes with risk. If two stocks have the same momentum score, but one is less riskier than the other, then we will allocate more weight to the stock that's less risky. So we do this systematically across the strategies. The idea is that while, yes, momentum is a slightly higher risk strategy, we cannot eliminate it, but we'll try and control it at the margins to the extent that we can.
So, folks, please check out the Key Information Memorandum.
Yes.
Did I got it right? KIM, yeah?
Yeah.
So, the Key Information Memorandum is something that you should check. The fund documents, all of them. And please check out the presentation that's available on the Axis Mutual Fund website. All of those details are there. Feel free to download it and have a look at it. Karthik, our last standard question for all our guests out here: what book are you reading, or any recommendations that you have?
The book I'm currently reading is Broken Money by
Nice.
Alden. So that's the first one.
What's it about? I haven't heard of it.
It's basically about how different currencies have evolved over time, or different things have evolved as a currency through time, and how technology has facilitated it. So it's looking at currency from the lens of technology and saying what is the advantages and what is the disadvantages. Starts with the oldest form and then moves on to monetary, then moves on to fiat currency, and then increasingly talking about Bitcoin as well. So there is that. And from a behavioral finance perspective, it's Thinking Fast and Slow. I would recommend that one. But yeah, those two books.
Broken Money and Thinking Fast and Slow. With that is a wrap on this episode of PaisaVaisa. My guest, Karthik Kumar, Fund Manager, Equity at Axis Mutual Fund. Folks, the NFO is over, but obviously the NAVs will be out in some time, so you can catch all of that. But Karthik, I wish you all the best for the new fund and hope to have you back. Thank you so much for doing this for our listeners.
Thanks a lot, and thanks again for having me on the show.
Thank you.